Hi there, and welcome to your free education for the week. Today we're going to discuss on how to trade breakouts objectively, so especially with the use of trends. So without further ado, I'm going to share my screen with you, and you should be able to see my screen right now. And you can see here basically a chart. Remember, a chart is a chart. It doesn't really matter what you trade, whether you be trading stocks, forex, futures, and simply what you can see based on technical analysis, we have a two-dimensional chart. We see price, you see time. So let's go through and discuss about trends and how to draw your trend lines objectively. There's a way on how to draw it objectively. And first, let's define what trends are. So there are two types of trends. One is what we call an uptrend, where it has a series of higher highs and higher lows, and a downtrend is simply a series of lower highs and lower lows. So you can see based on this diagram that if the high of the day, or depending on the particular time frame, is higher compared to the previous high. So if you're dealing here, simply put with buying and selling based on price, is that, mind you though, that highs and lows, or these high price and low prices, can't be retail price points. They are institutional price points, because even if we combine our monies together, there's no way that we'll be able to create a high price or a low price. Okay, so just letting you know that every highs and lows are institutional price points. So in other words, if someone was willing to purchase higher compared to the previous high, then that means something. So in other words, the valuation of the particular asset class is worth more than anything based on news. So for example, if the price right here is, say, $1 million, a piece of property is worth $1 million. And that piece of property is located in a good area, good school, close to supermarket, and you know that there's no supply. The location is great, and as you know, in real estate, it's all about location, depending on as well, of course, on the location. And the condition of the house is simply up to par, right? And the question now is, are you going to bid over $1 million or not? Especially when something is in demand, when there's not much supply within there, and you have a lot of demand for it. So you're going to place an offer above $1 million, because if you're going to place an offer below $1 million, so for argument's sake, you're putting in 900,000, but you have other people lining up, and they place a bid at $1.1 million, then forget it. Your 900,000 won't be accepted unless you're willing to keep on bidding over and over again above the asking price. Okay, so that's what basically means, that the higher price is higher compared to the previous high, and the low of the day is higher compared to the previous low. A seller is not willing to go below the low and the previous low, and if you're placing a bid below this low is, say, 750,000, the seller will basically say, and you're, sorry, if the lowest of the day is 750, and you're placing a bid at 700,000, the seller will basically tell you to get lost. It's too low. They won't even look at your offer. And here in this particular case, maybe someone put it at 800,000, someone placed a bid or made an offer, and the seller basically accepted it. Okay, so that's basically how it works. So when something is hot and you know that something is in demand, then the price will keep going. So based on time will basically have a certain time frame based on the high and the lows and the open and the close, right? So, and then that means then that the odds and probability, if you're dealing with based on probability of winning, of buying, then your probability of winning is basically high. The same holds true in a downtrend where you have a series of lower highs and lower lows, meaning that the high of that particular time frame is lower compared to the previous high, and the low of the particular time frame is lower compared to the previous low. So in other words, if someone's trying to place a bid when there's no demand, but there's a lot of sellers resisting price points, and you're trying to sell something that no one's buying, and someone basically offered way below the asking price, and the seller accepted it, then the odds and probability that the price will continue to keep dropping is highly probable. Likewise for the low. Someone plays an offer below the previous low, the seller accepted it, and that means that something is up, there's more selling than buying itself. Okay, so objectively, that's how trends are being defined. Always remember that. Uptrend, series of higher highs and higher lows. Downtrend, a series of lower lows and lower highs. Okay, moving forward from there. Now, if there are 3 bars where you have a downtrend and then followed by an uptrend where you have a series of lower lows and then a series of higher highs and higher lows, the midpoint, which is the lowest of 2 points of the low, creates a trough. Likewise, from here you have an uptrend followed by a downtrend where you have a series of higher highs and higher lows, and then preceded by a lower high and a lower low. Over here, someone was willing to buy higher compared to the previous high, then all of a sudden, someone decided in terms of selling or buying them previous to the previous high, no one's willing to make an offer higher compared to that. Buyers disappeared, then pretty much when there is a peak, you have a starting point of something. If you have a trough, it's a starting point of something. Okay, so that's something to remember. Okay, let's go through an example right here. We'll go through a live example. I'm going to draw an uptrend line and a downtrend line. When you're drawing downtrend lines, you are grabbing or taking simply the peaks. Remember, a peak is when you have 3 bars, higher highs and lower highs. And identifying the major peaks versus minor peaks. And to draw an uptrend line, we're simply identifying minor and major troughs. Remember, troughs simply dictate when you have a lower low followed by a higher low. Okay. Okay, so when you're drawing a trend line, it's very simple. For an uptrend line, find the lowest low, and there's certain rules in candles, a minimum of 72 candles, by the way. Okay, if I'm gonna find the lowest low, and to draw an uptrend line is simply connecting the troughs, which is simply a bunch of higher lows. So notice this, if I'm going to draw from the major low followed by the next major low, which is now a higher low, and what you notice over here, it broke out. Before that happened, over here, this is valid. Notice there's a lot of separation from the price all the way down to the uptrend line. What it means that at one point in time, somewhere, sometime, is going to be tested, which it did basically from here. Okay, so now that this has created a new trough, then the new trend line will be this, and then for it to be created objectively. This will still be valid somewhere sometime in the long run, in the future, that if this decided to basically drop, it's going to go drop back down to 7345. Okay, but for now, that's no longer valid right at this point. We're going to erase that. Then, from the next low, major low, then you need to find where it's valid. That is definitely not valid because it's no longer within, already broke out. It doesn't exist either because now it broke out. And the next trough is now there. So what does this mean? It now means that if price chooses to drop, it will drop down to this broken trend line, which trend lines acts as support of price as well. And if you identify where a good area of demand and supply is going to be, so you normally create zones. So in this particular case, there is a zone of demand where there's a buyer and seller, mainly buyers supporting price point. So if I'm going to draw that zoning, mind you, at one point this is strong because it broke out, came back down, and then it's just hovering within that zone area of demand, rebounded, came back down, breaking out, and now if price chooses to drop, where there is an intersection between demand and the trend line, that's where the most powerful price point is going to be. Okay, so that's simply within the constraints of an uptrend. Okay, how about downtrends? Well, to draw a downtrend line is also the same. To draw it objectively, find the highest peak, connect it with the next peak, now creates a lower high. So this is still basically in effect. I'm going to draw from here to here. So I want you to notice that you have two converging trends, an uptrend and a downtrend. And notice from this price, it broke out on this downtrend line, where I call it as a secondary downtrend. You have a primary downtrend, secondary downtrend. This is a very powerful candle where it's breaking out, and that means that price will retest supply, major supply area between 704 and the high of this one at 7405 to create a new higher high. Since we are in an uptrend, we have a series of higher lows and a series of higher highs, and really from here, from a higher low, another higher low, from a lower high right there, breaking out. So the odds and probability that price will break out will go all the way up there to create a new higher high is highly probable. What is highly probable? 99.999%. Of course, with the caveat that the price will break out of this downtrend line right there. So how can you play this game, and how do we create then a trade with this one? Okay, so based on explanation on price, let me just erase that. If all these candles are really that strong, where there is selling pressure, breaking out from this demand to the major demand, also with sellers right there, there's more selling than buying itself, then this candle shouldn't be bullish. Technically, this candle now should have broken out all the way down here, where this trend line didn't exist, to retest this lows right here. But he didn't want to do that. Instead, you have some buying pressure that got supported 73.78. Instead, buyers came in and pushed the price to the upside, breaking out on this trend line. This is a good technique of buying. This is where the setup of buying breakouts is going to happen. But where's your targets? Well, you have your target points within distance from here to here. And mind you too, though, since price is being driven by news, I know there's news coming in around 15 minutes, so it all depends on where price is going to be. It can easily come back down within the support area of this demand and within the uptrend before it can continue to go to the upside, or currently stalling at this point in time, and a push or a continuation of the force from this candle. And that is now where the next probability is going to be. So the distance in terms of profit is within these constraints. Within these constraints in order to create a new higher high. So in other words, you have approximately right there 10 pips, 14 pips, and beyond around the 20 pips, which is also to create within that high right there. Okay, so that is also a possibility of what the price can do between 20 pips and beyond. All right, so that's how you use trend lines as a form of breakout, and that's how you trade trends or trend breakouts as a technique. Okay, so here's basically an example. When this one didn't exist, I have an entry point to go long, and when it broke out because of this candle right there, there is another entry point. Here's my target point, which is in between the zoning area of two supply levels. All right, guys, I hope you enjoyed that. And if you have any questions, please email me at esttraders@gmail.com, and I'm more than happy to answer any of your questions. Take care till next time. Happy trading. Once again, that's my email address is estetraders@gmail.com. Take care and happy trading.